Hello, everybody, and welcome. This is Bennett Tchaikovsky, also known as the Accounting Professor. Today, we're going to go ahead and take a look at some cash flow questions. This is going to be a big video, so let's have some fun. So this presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without my express written consent. I'll get it right eventually. And the opinions herein are those of myself and not my employers, including but not limited to Irvine Valley College and the South Orange County Community College District. So let's go ahead and take a look. So we've got over here, we've got Zizix Inc., which is one of my favorite things, is just because it's the name of a road as you're heading out into Vegas. I actually knew somebody by the name of Zizix on my son's baseball team. So you got to wonder about that conception. Just kidding around. Maybe I'm not. So we come over here and we basically see over here, you've got a balance sheet and we see additional information, and then we're asked to go through and prepare a statement of cash flows in proper form. So the first thing we want to go through when we get one of these questions is we want to set up what we call the skeleton. So the skeleton of this is going to be Zizix Inc. Statement of cash flows for the year ended 12/31/30. And when we set up the cash flows, what exactly does this cash flow do? It's one of the most important documents for investors in accounting. And as we go through over here, we're going to look at our friends over here at Meta Platforms. And oh boy, why did I get this weird stuff going on here? Let's try this again. Meta, there we go. Fantastic. Okay. We're going to go ahead and look at their quarterly results, and we're going to go to the statement of cash flows. And when we see this over here, we see revenues, and we get down to our net income and the costs and expenses. But what's really kind of crazy is this really the net income? Do they only really earn 41 billion? Well, the statement of cash flows is going to kind of help us discern and kind of look more into, well, what's going into these numbers. Now, what's really important about Meta is that they have they pay their people not only in cash or salary, but they always also give them stock. So what you see here is stock-based compensation, right? And this is a non-cash item, meaning it does not draw in cash. Now, when they're going through and they may be saying, well, we're buying back stock to, do equity awards. They don't really necessarily have to do that. But again, taxes paid related to the share of net settlement of equity awards. I, I don't necessarily agree with this, but in any event, they have a lot of non-cash items, so their net income actually looks a lot stronger than what it does right over here because these amounts include, especially the R&D is going to include a lot of stock-based compensation. So, but what does the statement of cash flow tell us? Well, it's going to tell us where our money is coming from. And if we look at this down here, and I'm going to always start with the bottom, which are financing activities, meaning that what are financing activities? And think about it like this. If we pay a dividend, payments of dividend, if we sell our own shares, meaning if we sell stock, if we repurchase our own stock, this is not the stock of others, and do we issue any sort of debt? With right over here, Meta Platforms issued 10.4 billion worth of debt during the 9 months ended September 30th, 2024. Working up to the next one, so financing. How are we financing our operations? And remember, this is going to change over time depending upon the company. Cash flows from investing activities. Well, what exactly is an investing activity? We buy equipment, we sell equipment, we purchase investments. This is not our own stock. We resell investments, and we buy businesses or other investing activities. And when you look at this over here and you look at the balance sheet of Meta Platforms, they have a lot of money in marketable securities as a current asset, right? So you can kind of see over here, they've got about 27 billion in marketable securities. And this compares with Apple that has a lot. So financing, how we finance our operations, investing, how are we choosing to go through and we're purchasing equipment, we're selling equipment, we're selling securities, we're buying securities, whatever it may be. And then lastly is operations. Now, when you look at this over here, the reason why this is so important is that there are non-cash items included in getting us to net income. One of those famously is depreciation. Why is it a non-cash? Think about the journal entry. When I record depreciation expense, I'm debiting depreciation expense and I am crediting accumulated depreciation, right? When I record stock compensation expense, I'm accrediting additional paid in capital common stock. So when you look at this over here, the importance of this is to tell investors, well, what's really having a draw on cash. So, and if you look at this also the same part too, you see the net increase in cash and restricted cash, cash equivalents at the very beginning of the period, cash and cash equivalents at the end. And if you look at our balance sheet, kind of going to that 41 billion, our cash went up by roughly about $2 billion. The statement of cash flows is telling us, well, where did that increase come from? Was it from financing? Was it from investing? Was it from operating activities? So let's go back over here. So when we start up the statement of cash flows, we're going to basically make the skeleton. And to kind of help us with this, let's go ahead. And I always kind of get this stuff confused, but it's like right over here. There we go. Okay, so we're going to have cash flows from operating activities. Then we're going to have total cash blank operating activities, cash flows from investing activities, total cash blank investing activities, cash flows from financing activities, total cash blank financing activities, total change in cash, beginning cash balance, and then our ending cash balance. Now, when we do the statement of cash flows, we have the answer in front of us. Cash went from $1 million to 3 million. So my total change in cash is going to be $2 million. My beginning cash balance was 1 million. And so my ending cash balance is going to be 3 million. And I dropped the zeros to get with the heroes, and we're going to say amounts in thousands. Okay. So this is the kind of the puzzle we're looking to kind of go through and solve today is when we look at this over here, what's causing this change in cash? And lastly, most importantly, are non-cash transactions. Now, if you are taking my class and you're going to be taking one of my exams, which unfortunately, well, I pity you, which is why I try to help you out as much as I can. I will be giving you a question that is going to be what I call fill in the blank cash flows, meaning that I'm going to give you a skeleton and ask you to fill in the results. So I would give you something like this. So if you're forgetting how to set something up, turn the page. Oh, actually, no, I can't use that anymore. We're going to like flip through the page, not turn it, but we're going to flip through it and we're going to find the statement of cash flows, fill in the blank. So we're going to come right over here and basically copy out this skeleton. Now, let's go to the next one over here. Now, what's the next thing we're going to go through and do? Well, the next thing we're going to go through and do is we're going to use our old friend, the T account, right? So we've been using the T accounts all along throughout the semester, which is probably one of the most important tools in accounting. And the reason why we're going to go through and do this is because this is going to help us solve our cash flow problems. So just give me a moment and I'm going to get everything set up. Okay, so what we're going to go ahead and do is we're going to set up our T accounts. And what we're going to do is we're going to take that information from the balance sheet and put it into T accounts. So we're going to start over here with accounts receivable. So our beginning balance of accounts receivable was 300, ending was 400. Now, if you're not remembering, how do we go through and use a T account? We've got our assets equals our liabilities plus our owner's equity, right? Crazy place where everything nutty happens is Washington, D.C. Debit credit. Assets will typically have debit balances. They'll be increased with debits and then decrease with credits. Liabilities and equity accounts will have credit balances. They'll be increased with credits and then decrease with debits. And for good measure, expenses are recorded with revenue. Expenses are recorded with debits. Revenues are recorded with credits. So we got over here accounts receivable. And then we've got over here our allowance for doubtful accounts. So over here, we've got our ADA. Then we're going to have our inventory. Remember, the allowance for doubtful accounts is a contra asset account. It's typically going to carry a credit balance because it is reducing the carrying value of our account. So over here, we'll just call this the ADA. My inventory is an asset account. It had a beginning balance of 280 and ending balance of ending balance. Wow, almost grab over here of 400, beginning balance of 500. Coming over here, we have equipment. Equipment had a beginning balance of 900, ending balance of 1200. Accumulated depreciation on equipment. Over here, opening balance of 200, ending balance of 300. Then over here for our non-current, excuse me, for our current liabilities, accounts payable, opening balance of 100, ending balance of 540. Liabilities and equity accounts carry credit balances. Then over here, we have bonds payable, and then we have our premium on bonds payable. Bonds payable, opening balance of 480, ending balance of 1.1 million. Premium on bonds payable, 0 opening balance, ending balance of 20. Then over here, we have common stock, and this is including both par value and additional paid in capital. This over here started at 1 million, and then it ended at 1.7 million. Treasury stock. This is when we repurchase our own shares. This will have a debit balance because it is in the equity account and it shows up as a negative. So I'm going to have treasury stock over here of 200 and then 300,000. If we look at our friends at Meta, what you'll see over here is that on stockholders' equity, I guess they retired it. Yeah. Okay. The better one to look at for this anyways is a Home Depot. And then lastly, we're going to have our retained earnings. Our retained earnings had an opening balance of 1.1 million, ending balance of 1.6 million. Then over here, we have our cash T account. So the only thing I have done so far is took the time to set up the T accounts, which I'm putting in from the balance sheet. This is 29. This is my beginning balance, my ending balance, my beginning balance credit because it is a contra asset account, ending balance credit. Over here, inventory, beginning, ending, equipment, beginning, ending, beginning, ending. Remember, this is going to have a credit balance because it is a cumulated depreciation. Accounts payable, beginning, ending. Bonds payable, beginning, ending. Credit balance because it is a liability. Premium on bonds payable. If I gave you a discount, it would be a debit balance. Then over here, common stock, beginning, ending. Treasury stock, beginning, ending. retained earnings beginning, ending. So all we've done so far is we've set up the T accounts. Okay. So before we go through and start analyzing the different information in these T accounts, we need to deal with the additional information first. The way this is going to work is we're going to put it into the T accounts and generally, with a few exceptions, do the opposite to cash. So let's go ahead and start. My net income for the year was 700. Remember, when it comes to a statement of retained earnings, I'm going to have my beginning retained earnings plus my net income minus my dividends. This is going to give me my ending retained earnings. If I were to do this in a T account, remember, because it is part of owner's equity, beginning retained earnings, net income, dividends, and then I'm going to have my ending retained earnings. So that's how we kind of go through over here and see this. So my net income for the year was 700. So I'm going to put over here 700. I'm going to label this over here as letter A. I'm increasing it with the net income. I'm going to do the opposite to cash. Now, in the cash part over here, I have my operating, investing, and financing. In financing, buying or selling my own stock, buying or selling, repurchasing my own bonds, and paying dividends. Investing, buying or selling, or excuse me, sale of equipment, purchase of equipment, sale of marketable securities, purchase of marketable securities. Everything else goes into operating. So I'm going to put my net income right over here. I'm doing the opposite to cash, which means I'm going to go ahead and make this over here, make this a debit. So because I credited retained earnings with the net income, doing the opposite to cash or showing this right over here as a debit. Let's go to the next one. I declared and paid 200 of dividends. So if I'm paying dividends, where does that go? Over here, it's going to show over here as a credit to retained earnings. For every credit I need a debit, this is going to go into financing. This is going to be a payment of dividends. So right over here, this is going to show as a credit to the financing activities. When I pay dividends, this is giving back to my shareholders, and this is therefore going to be a credit. Okay, let's go to look at letter C. Now, equipment sales. These are treated differently than what we've been doing before. So this has a special rule, so we're going to learn that rule right now. When we do equipment sales, and if you're taking my class, you will be seeing this constantly on your final exam because I love to test this. Okay, so when I sell equipment, there's always the same journal entry, which is going to be debit, credit. And when I go through and do this, when I sell equipment, I'm receiving cash. But I also have to take that equipment off of my books. And so I'm going to basically come over here. I need to debit accumulated depreciation and I have to credit the equipment account, right? Because remember, I accumulate the depreciation. Once I decide to go through and sell that equipment, I'm going to go ahead and debit the accumulated depreciation. Now, oftentimes this will never balance. Balancing, if I need a debit, it's going to be a loss. If I need a credit, it is going to be a gain. So let's go ahead and take a look at this right over here. So I sold equipment for 28. So I got 28 of cash. The equipment cost me 50 and had accumulated depreciation of 15. Let's kind of look at this intuitively. The value of this equipment on my books was 35, but I only got 28, and so I have a loss of 7. But to make this easier on ourselves, oh, debits of 43, credits of 50. What do I need to do to balance? I need to credit a debit. It's going to be a debit of 7. So I'm going to have a loss on sale of equipment. So what do I do with this? Let's go ahead and put it into the T accounts. I'm going to put this directly in. So I'll go over here on equipment. I'm going to credit equipment for the 50. I'm also going to debit accumulated depreciation for 15. And we'll give this a nice little color right over here. Okay, and then I'm getting, so we've dealt with these two parts over here. Okay, now I have to go through and deal with my loss. Now with the loss and gain, this is kind of a weird one. Okay, this is going to go directly into the operating section. Sale of, or excuse me, it's going to say loss on sale of equipment. And this is going to go over here directly as a debit. Now, I could take a long time to explain this to you, but just add back the loss. The reason is because it doesn't necessarily really draw on cash, but more importantly, when we go to investing, when we sell equipment, sale of equipment, this already has the loss embedded into it, so we have to go through and add it back. So we're getting cash of 28, and this is letter C. So let's recap this. When I get a sale of equipment, I want to memorize this journal entry. Very important journal entry, both in financial and in intermediate accounting. So what I want to go through and do, I'm receiving cash for the sale of equipment. I need to take that equipment off my book. So I got to credit that equipment. I got to debit accumulated depreciation on equipment. Whatever I need to do to balance. If it's a debit, it's a loss. If it's a credit, it's a gain. The equipment, put it right over here into this part over here. And then my loss on sale is going to go into the operating section. And then the cash proceeds is going to go into the investing section. Very important to remember, especially in my class. You're going to see this constantly on the final exam. So let's go ahead and go over to letter D. Sold equipment for 72. I got 72 of cash. The equipment cost me 100 and had accumulated depreciation of 40. Well, the value of this equipment to me on my books was at 60 or 100 minus 40, but I got 72, so I'm going to have a gain of 12. And following the same logic, right? So we're going to follow that same logic that we just went and did for this part. I'm going to go through and put the cash in investing. Remember, you never, ever in my class are going to combine sales of equipment. We're always going to show them separately. Okay, I'm going to show over here the equipment had a cost of 100 and it had accumulated depreciation of 40. So I'm going to go ahead and make sure I post these into the T accounts. If I don't do it, I'm going to be in big trouble. Right over here, letter D, gain on sale of equipment. This is going to be a credit because I'm crediting the balance directly. Again, the cash proceeds inherently show the gain, so I'm going to have to go through and remove it. So that's what we're going through and doing here. Go ahead, and we've got that going on. Okay, so we've got A, B, C, and D. Let's go ahead and take a look at letter E. Okay, so I received equipment by issuing a bond of 200. If we think about this transaction, I'm receiving equipment and I'm crediting bonds payable. This transaction involves no cash. It's basically what we call a non-cash transaction. Remember, equipment is an asset, and I show an increase of the asset with a debit. Bond payable is a liability. I'm going to show that increase with a credit. So over here, I would be debiting equipment for 200, crediting bonds payable. Now, what I'm going to do here, though, is this involves no cash. So I'm going to come over here. Basically, I'm receiving equipment for a value of 200, right? And over here, I am crediting bonds payable for that same amount. But this involves no cash, so I don't touch any part of the cash T account. Okay. So what do? I'm going to come down over here and list this as a non-cash transaction. I'm going to basically say received 200 of equipment by issuing a 200 bond payable. That's all I need to do. Just say the non-cash transaction. We're good to go, but you have to put it into the T accounts. Very important to do. Okay. Now over here for letter F, Okay. On 10/31/30, we issued a bond with a face value of 420. What's going on there? And received cash proceeds of 440. Now, if we think about this, whenever we're issuing a bond payable, we always show the face amount of the bond, right? So we always show bond payable at the face amount, and then we have cash for 440. That means the bond was issued at a premium of 20. So what I'm going to go ahead and do is I'm going to put this again into the T accounts. I'm going to credit bond payable for 420. I'm going to credit premium on bond payable for 20. Now, when I go through and I am going through and issuing a bond and receiving cash, where does that go? And it is going to go into financing. So I'm going to have a bond issuance where I received cash of 440. Right. I don't say increase in bond payable, increase in premium. No, I'm just going to show the cash from the bond issuance. Or you could say proceeds from bond issuance. Okay. Now, so we've gone through, and this is the most important part. You've got to deal with that additional information first, right? We put this all into the T accounts, the equipment. Make sure you know how to do this, especially if you're taking my class. I love to put this on tests, and it's peppered throughout. So over here, and let's go to it. Now, at this point, what I'm going to go through and do is I'm going to balance the T accounts. So watch this over here. So with accounts receivable, what do I need to do to balance? Well, to get from 300 to 400, I need a debit of 100. I'm going to do the opposite to cash. I'm going to credit cash for 100. But what I'm going to call this is the way I'm going to describe this is what's happening in the T account. Well, over here in the T account, I increase my assets with debits. My asset is increasing. Over here, this is going to be an increase in accounts receivable. Okay. Allowance for doubtful accounts. Here, I'm going to debit this for 20 to make it to balance. I'm going to do the opposite to cash. Now, very important, I do not call this an increase in the allowance for doubtful accounts. Think about it. Where did this come from? When we were going back and dealing with writing off accounts receivable, we learned that we created an allowance account called the allowance for doubtful accounts. And the very last journal entry we made is we debited bad debt expense and we credited the allowance for doubtful accounts. So I'm going to call this what it is, which is going to be bad debt expense. So I don't call this an increase in the ADA, and there's going to be another one just like it. Let's go to this one over here. Inventory went from 500 to 400. So I need a credit to balance the account. I do the opposite to cash over here, inventory. Now, the way I describe this is my inventory is decreasing. Decrease in inventory for 100. Remember, pretty much everything is going to go into operating except when I'm buying back my own shares, I'm selling shares, I'm issuing a bond, issuing a dividend, purchasing equipment. Let's go over here to look at this one. So over here, my equipment went from 900 to 1.2 million. But I exchanged equipment for a bond. I got equipment by issuing a bond, and then I sold some equipment. So what do I need to do over here to make this balance? Well, right off the bat, I know that 900 plus 200 minus 150 equals 950. So I know that this T account on its own will not balance. What I need here is 900 plus the 200 plus the 250 minus 50 minus 100 is 1.2 million. Now, this represents a purchase of equipment. I'm going to do the opposite to cash in the investing section. So over here, I'm going to call this a purchase of equipment. And over here in investing, and I usually will say on exams, it's like with the exception of the above, all equipment purchases were made in cash. Now, over here, going to accumulated depreciation on equipment. This is called the balancing game. Does 200 minus 55 equal 300? No, it does not, right? So what I need to do over here is I need to say to myself, well, okay, um, what do I need to do to kind of go through and balance this? Well, I'm probably going to need a credit for 155. And let's see if we can get this to work. So 200 plus 155 minus 15 minus 40 equals 300. Now let's think about this. When I credit accumulated depreciation on equipment, what account am I debiting? Well, I'm going to be debiting depreciation expense. I do not call this an increase in accumulated depreciation. Even over here at our friends at Meta, they call it depreciation and amortization. So this is going to be in the operating section. I'm going to call this depreciation expense. And this is going to be a debit for 155. So, by the way, in terms of points, right? This here, and this one, as well as the bad debt, these are going to be worth a lot of points, a lot more than like a decrease in inventory. Why? You either have to come up with the right account description or the name to get to it. Let's keep going. Accounts payable, going from 100 to 540 to balance, I need a debit. Excuse me, I need a credit of 440. I do the opposite to cash. This is going to be an increase in accounts payable. Let's go ahead and look at our next one. Bonds, 480 plus 200 for that equipment for bond plus 420. I'm balanced. Over here, premium on bonds payable. I am also balanced. But coming down over here and taking a look at the common stock par, to this I need a credit of 700. Basically, this means I must have issued stock for cash. So we basically issued stock proceeds from stock issuance, right? You could say, do not call it an increase in common stock, call it a sale of common stock, proceeds of common stock. But we do not want to call it an increase in common stock. You can say that for payables, receivables, inventory, but not these other accounts. So again, this account is balanced. Now with treasury stock over here, what do I need to do to balance? Well, I went from 200 to 300. With this one, you got to be really careful. Treasury stock has a negative balance on our balance sheet, just or at least a negative balance in owner's equity. And I'm going to show you a company where we can really look at how this works in action, which is our friends at High Definition or at the Home Depot. And when I look at the depot right over here, treasury stock, $95 billion as a negative amount in owner's equity. So when you see that negative amount for treasury stock, you'll understand what it is. So over here, I'm going to do the opposite to cash. And this really means it is a purchase of treasury stock. Or you could call it an increase in treasury stock. I would call it, but purchase is really the better way to do it. My retained earnings, ending balance of 1.6 million. Okay. Now we are ready for the big reveal. All of our T accounts have balanced, and so we're ready to come over here to go through and to put the final touches on this to see if things work out. Sometimes things work out, sometimes they don't. But what's really important in my exams is you've got to write out the work because I'm going to give you a lot of partial credit. So coming over here, we're going to go ahead and take a look at, we've got total debits of 1.422 million, credits of 112 million, or a total of 1310. Over here, we've got basically 150. Now I went a little bit too quick. If the amount is a debit or a positive amount, this is going to be total cash provided by operating activities. If it's a positive amount, meaning it had a net debit balance, it is going to be provided by. And then over here for investing, because this has a credit balance, this is going to be total cash used in investing activities. If I look over here at those descriptions, net cash, net cash, I like to just kind of say total, but you could say net. I'd accept either. Coming over here for financing. Okay, right over here, 1,140,000 and then 300. Subtract these, I get 840, right? So this is going to be my total cash provided by financing activities. Now, to see if this works, right? Did I pull off the deal of the century? Did this thing actually play through? What I need to go through and do is I'm going to go right over here. I'm going to say, okay, my cash provided by operating activities was 1.3 million. My cash used in investing activities was 150. My cash provided by financing activities was 840. And when I come right over here, what I'm going to get is going to be 2150, 150, and I get a $2 million change, which is my total change in cash. Now, if you're taking my test and it doesn't balance, make sure you go back through and you check your work. Very important to do. You got to check that work, right? Because oftentimes it won't balance. However, if you're going through and you're writing this out, I am going to give you a lot of partial credit. I give a lot of partial credit, basically, especially for this exam. It's one of the harder, basically more challenging parts when we're going through and doing these types of problems. And again, what I will tell you is you want to make sure you're going through and you're writing out everything. So let's go through now. Now, when we prepare the statement of cash flows, it's relatively simple. If we've gone through over here and have done the T account, it's going to be pretty simple. If it's a debit, it's going to be a positive amount. Over here, if it is a credit, it is going to be a negative amount. So over here, my total cash provided by operating activities is going to be 1310. So just made my life a little bit more difficult, but that's okay. So my cash flows from investing, I have over here sale of equipment, sale of equipment. It's a debit, so it's going to be a positive amount. Over here, this is going to be a credit because a negative amount because the amount is a credit. And then over here, this is going to be my total cash used in investing activities is going to be a negative 150. Last one, cash flows from financing activities. Right over here, I've got the payment of dividends, proceeds from bond issuance, stock issuance, and then the purchase of treasury stock. Because these amounts over here have credits, I'm going to go through and show those with a negative amount. And then over here, I'm going to show this with the proceeds from bond issuance because they are debits. I'm going to show that with a positive. And then we add these up over here and I get to 840. So my total change in cash right over here equals up to the 2 million, or because we dropped those zeros and got with the hero. Okay. So right over here, we've got, and there you go. That is a statement of cash flows. Now, I've been doing this for the last 10 plus years. My goal is to make this as look easy as possible. This problem really requires that you remember and you know how to use T accounts. This is by far the easiest way to go through and to do cash flows. If you're trying to go through and say, oh, Accounts receivable increase, so it's going to be negative. No, 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 dude. Put the beginning, put the ending, do this, do the opposite, and what you see here is your description. Thank you so much for being with me here today. Feel free to leave comments in the comments below. And if you're looking for any other kind of assignments, or if you're looking for any other help, I'm not Bennett GPT, but you can always try to find out. Anyways, have a great rest of your day, and I look forward to seeing you on the next video. Have a great one.